All right, so it is now 7:30 p.m. Eastern Time, and I am Sharon Harrell, your retirement coach diva, and I am here this evening with Joanne McGehrin of JP McGehrin and Associates, and I'm just every month I say I'm excited, but this month I know that everybody's going to get some great information that you all have been waiting for a while, because a lot of you out here in the DC area are federal government employees, and you want to know about your retirement and your entitlements, those benefits, the health insurance, life insurance, TSP. How does that apply to you? How does that apply to your family? So we're going to get started with Joanne. And so good evening, Joanne. How are you?
Good. Thank you, Sharon. Thank you for having me this evening.
Oh, no, thank you for being with us this evening. So we're going to make sure that our attendees know that at any time you drop into the chat your questions, your comments, as Joanne goes through this information. And while we get started, Joanne, if you could just tell us a little bit about yourself, how you came to be a guru in federal benefits and retirement.
Not quite a guru. No, quite a bit about a little bit. So I started my career in 1980 with the Office of Personnel Management. I was a federal employee working with retirement cases. 3 years later, I figured it was about 10,000 retirement cases later, transferred to the training branch, and I trained other examiners. I trained personnel officers. Unfortunately, I loved the job, but there was quite a bit of travel involved. So in 1987, I left, had small kids at home, left the government, kind of bumped into the government again, because that's when they brought on the new retirement system, the new FERS system. So I went back to OPM on a contract basis, and then I kind of merged into doing retirement webinars, retirement seminars. And then a little over 3 years ago, that quickly moved into retirement webinars. So I've been doing something with retirement for the last 40 years. And I really enjoy doing the retirement seminars, the retirement webinars.
Well, I can attest that you have been great giving information to federal employees across the country, really, in different areas. So the first question I want to ask you when it comes to federal benefits is, what is the top question that employees ask you?
I think the top question is, so how much money am I going to get? So, that's kind of the bottom line. But, when I think about retirement, when I go through my retirement seminars, my retirement webinars, there's really like 6 key topics. The first one is eligibility. When are you eligible to retire? And that's pretty simple. Under FERS, it's once you reach your minimum retirement age, which is between 55 and 57, and you have 30 years of service, or once you're 60 with 20 years, 62 with 5 years. So it's pretty easy to look up your eligibility. The next question, how much money are we going to get? And that's actually a pretty simple calculation also. For the FERS basic benefit, we take your highest 3 years of salary. Usually it's your last 3 years of salary. We do include the locality pay. We add it together, divide by 3, and we call that your high 3 average salary. And the basic calculation in FERS, 1% of the high 3 for each year of service. 30 years of service, 30% of the high 3. 30 years, 7 months, 30 and 7, 12% of the high 3. So it's a very simple calculation. You do get a higher benefit, however, if you work to 62 and you have 20 years of service. Then you get 1.1% of the high 3 for each year of service. So basically, as soon as you hit that 62 and 20, the annuity increases by 10% instantly, because you get that extra 0.1% for each year of service. The next big thing at retirement is, so what are you going to do about your survivor benefit? So when you retire, you have to choose whether you're going to take a survivor benefit for your spouse. And most people, their first reaction is, of course, I'm going to elect the full survivor benefit for my spouse. And that's fine. It's going to cost you 10% of your retirement. This retirement that you are planning to share for the next 30 or 40 years. So there's other options there. That I tell people to just look at. And we want to look at, well, what's your spouse's income? Do they have any income of their own? Do they have their own retirement? What are your assets? Look, let's throw everything, put everything down on paper and consider what you want to do with this survivor benefit election. Oh, I do want to throw something in there though. One of the really important things about the survivor benefit election is health insurance. Because if you don't elect a survivor benefit for your spouse and you were to die, they wouldn't be eligible for federal health insurance.
Yeah, yeah.
Next thing would be life insurance. A lot of people make changes in their life insurance when they retire because it's expensive. You know, as you get older, that option B gets very expensive. And maybe you don't need it anymore. Maybe you've got other things in place because you've got your survivor benefits, you've got your 401k plan, your house is paid off or close to paid off. So people like to reevaluate their life insurance. Then one of the really big questions for retirees getting close to 65 is, well, what am I going to do about Medicare? And that we could do a whole session on Medicare.
Yeah.
When are you going to take Social Security?
Yeah.
62, 66, 67, 70, huge topic. And then the last one is, what are you going to do with your thrift account? How are you going to distribute your own money back to yourself for your thrift account? And each one of those topics are pretty hefty topics. So I urge people to start thinking about retirement a couple of years before and just start to mull over these different topics until you get comfortable with it.
Right, definitely. Because we know that a lot of times people don't think about retirement until they get closer to their retirement eligibility, or something happens where they are forced to consider retirement, whether it's something happened to them personally, you know, or something with a family member or something, you know, like that. So when should they really start planning for retirement?
Well, you know, as you said that people come at the last minute, one of the biggest comments on our retirement seminar evaluations has always been, I wish I'd been here 10 years ago. So we started offering mid-career seminars, which are very similar to the retirement seminars. It just has a little different focus, just kind of a heads up. Pay attention. Excuse me one second. I'm fighting a cold, so I'm just going to turn my mic off each time I have to cough. So it's a heads up. And the real gist of the federal retirement, what do most of us want in retirement? I think we'd like to have the same kind of standard of living that we enjoyed as employees. Maybe not the lean years, the good years, right? Those years at the end. So the goal is to make up the same kind of money that you had before you retired. And with the FERS retirement system, you can do that. Between your FERS basic benefit and your Social Security and your thrift account, many of my retirees, people going out, are ending up with the same net income that they had as employees when we add everything together. The key is using the thrift account. And so the reason we like to get mid-career is say, you can't wait till you're 50 to do this. You really need to get that thrift account going early. But then the next mark is 5 years out. A lot of agencies will market their retirement seminars, webinars 5 years from retirement, because there's a couple of 5-year requirements. To continue your health insurance, you have to have it for 5 years before you retire. You have to be in some sort of federal health insurance, either yours, your spouse's federal health insurance, or TRICARE for 5 years prior to retirement. And the life insurance coverage. To continue it into retirement, you have to have it for 5 years prior to retirement. And then the next step, what I like to see, I like people to come to a seminar or a webinar 5 years out. So it's not too stressful, right? You can kind of listen in, don't have to pick up every word of it. Come back when you're about a year out or within a year, because then you're making decisions. You're choosing your survivor benefit. You're thinking about that life insurance, and you're making very specific decisions. I've seen people come to my seminars where they had their retirement application in front of them. They've got it all filled out other than that date, because they're making all the decisions. So it's kind of 3 phases when to start planning. Mid-career, get a heads up, see what your defined benefits are, think about what you're doing with your thrift account, and then 5 years out to really start planning, and then that last year to fine tune and make decisions.
Okay, well, that's great information. And I know that you also offer something for early career, those who are just kind of starting out in federal service.
Yes, we do. So again, this kind of spun off of those mid-career. People would say on their evaluations, you should give this to employees as soon as they walk in the door. So we started offering them. And what I do there is I just do a few hours, a really basic overview on the federal benefits. And really to point out that the first basic benefit in Social Security by themselves isn't going to do the trick. It's not going to give you the kind of income you want in retirement. you have to get that thrift account going early and just keep building it. And then a financial planner comes in behind me and basically does the same thing. Says you have to get that thrift account going. And if you're early in your career, you can't drop it in the G fund. You need to take a little bit of risk. You need to use some of the stock funds. And then you can go on to tsp.gov and they offer some webinars to get a feel for how to invest. But it can't all be G funds for a 30-year-old employee. Just because it's safe, it won't keep up with taxes and inflation.
Correct. So there are so many things that we could cover in this time for federal retirement. And one of the things I was just thinking about, you mentioned about the thrift savings. And so, when thrift savings first started, it was optional and still is optional for employees to participate, but now they are automatically enrolled. So do the questions that you receive about thrift savings from newer employees, is that different from those that are have been in the federal government a while?
Yeah, because for new employees, it's how do I manage my account? What should I do with my account? I do want to highlight, you pointed out for newer employees, now the government already automatically takes 5% out of their salary and invest in the L fund, the life cycle fund that's appropriate for their age, which I just love this. Waiting for a new employee to say they've got 5% extra that they can put away, it just doesn't happen. But what happened, first they started putting 3% in, then they changed it in 2020. New employees, they take 5% out, put it in the life cycle fund. They get the 1% automatic contribution. They get the 4% government match. They got 10% of their salary going in the thrift account in a life cycle fund. And the life cycle funds are a mix of the 5 different funds based on time horizon, based on when you plan to spend the money. And the further away that you are from your time horizon, so the younger you are, the more you can put in stocks. And the I fund, the international fund, and the common stock fund, and the small cap fund, because even if there's a drop in the market, you have time to recover. So that's why they put it in the life cycle funds. And then I encourage people, this is what my dad told me when I worked in the government, and you might have heard this too when you started in the government. First raise, didn't need it last year, don't need it this year. Put it in the credit union because that's all they had. They had the credit union in 1980. Yeah. So the whole time I worked in the government, my take home never changed. But boy, did I have a nice credit union account. When I needed something, I had it. So I tell people, every time you get a raise, bump your thrift account a little bit. And before you know it, you've just got, a lot of money growing, compounding in there. So the newer employees really want to know, how do I manage the account? The employees with more service are now getting towards what am I going to do with the account when I retire? How am I going to use this account to supplement? It's basically to supplement your defined benefits, because you're going to get this much per month from your first benefit and this much per month from your Social Security. They're pretty set benefits. You decide how you're going to take the thrift, when you're going to take the thrift. And just because you retire at 56 or 57 doesn't mean you have to spend your thrift account at 55, 56, or 57. You might work part-time somewhere. It's still a pretty young age to retire, fully retire. Leave that thrift account alone and let it just keep on growing. You could still manage it once you leave the government. You can still do inter-fund transfers. You can move the money around. Hopefully it grows. And then you can make a decision at a later date.
Yeah, definitely. So, with the thrift, did they start something recently with mutual funds, I believe?
They did. So they opened this mutual fund window, and I'm not the financial planner, so I'm not that familiar with it, but I have heard Karen speak about it, where you can buy individual mutual funds, but there's a fee associated with it. And if you're really interested in doing that, you can do that. But from what I've heard Karen talk about it, she didn't seem too thrilled with the whole concept. That there's enough investment opportunities within the C fund, the S fund. So the funds we've got the G fund, which is short-term government securities, very stable, but they don't pay much, but they're stable. We've got the F fund, which is a bond fund. We've got the S fund, which is small U.S. companies. We've got the C fund, which is a common stock fund. It's large US companies. And then the I fund is the international fund. So with those different funds, if you really want to get into the mutual fund window, you can move money, transfer money into that mutual fund window, but there's a fee attached with each time you take action with that.
So basically, employees need to do their homework and research before they try to start investing. And as you mentioned, TSP offers all types of training that's free. The employees can go online and view. They have a YouTube channel and things of that. So employees, federal employees, as well as their family members, because we don't know how long we're going to be here. So family members should as well be kind of educated on these federal benefits that they could have entitlements to.
Right.
So, yeah. And so one thing I have noticed is that talking to federal employees, they always say a pension, right? And it's actually an annuity, but I think people are educated on the difference of the pension and what a pension is and what an annuity is. So can you give a brief explanation?
You know what? I'll be honest with you. I don't know that I know the difference. I use the two phrases interchangeably. Now, the word annuity is an annual recurring benefit. That's what the word means. And with our federal retirement, we receive it on a monthly basis, but it's an annual recurring benefit. And many people use the word pension. Is there a different definition, Sharon? You may know the definition of pension versus annuity.
I don't know the definition of pension, but I do know an annuity is one that goes for the rest of your life. Right. So based on what federal employees or anybody that has an annuity, because you can purchase an annuity with your TSP as well, the money will last as long as you last. Right. Exactly. What's left may or may not go to a survivor or a beneficiary. So it's kind of like those that live long could benefit from those who don't live as long. Right. So money is paid out.
Yeah. So the annuity, the FERS annuity, is only paid to the employee, the retired employee, and they can choose a survivor annuity for their spouse. So you could take a reduction in your annuity of 10%. And in the event of your death, your spouse would receive 50% of your annuity. Or you could choose a partial benefit. It costs you 5%. If you die, it pays out 25%. Now, you mentioned TSP. Yes, one of the things you can do with your thrift account is you can buy an annuity from MetLife. Now, when you buy an annuity, it's at a set interest rate factor on date of purchase. I think the interest rate factor right now is 4.075%. So if you bought an annuity today at MetLife, with MetLife, it's at this set interest rate factor. And it's guaranteed for life. That's what the annuity is all about. It's about the guarantee. If you bought an annuity with your entire thrift account, then it means you don't have a thrift account. You don't have a C fund. You don't have a G fund. You don't have a PIN number. You own an annuity provided by MetLife. So it's sort of like MetLife owns the account. If you were going to do that, then you get a set amount and it's guaranteed for life. And there's a whole series of options. With all the different combinations, there's 18 different annuities that I can build up using the thrift, the MetLife annuities calculator. A lot of federal employees, though, look at this and say, you know what? I don't really need MetLife to do that for me. I can take my thrift money and I can control it myself. I can pay myself. So, an employee might take some of their thrift money and buy an annuity just to give them a certain guaranteed rate forever and leave some of their thrift money where they have control. Because you could take your thrift money yourself and just give yourself a monthly payment or a quarterly payment or an annual payment, and you own the account. And if you die, whatever's left in the account is just paid as a lump sum to your survivors.
Okay, so one of our participants who's listening in actually just looked it up to see what's the difference is. And they state, thank you, Debbie, who says that pensions are funded by the employer and annuities are funded by employees. So I would think that the federal is kind of a mixture of both, because it's not fully funded by the employee, but it's not fully funded by the employer.
Exactly. That's exactly true. Now, thank you for looking that up, by the way. Yeah, the FERS retirement system, how much you pay into the system depends upon when you were hired.
Mhm.
So for years and years, for 30 years, FERS employees have paid 0.8%, so less than 1% of their salary into the FERS retirement system. And then the agency's paying something like 16 or 17% of your salary into the FERS retirement system. And the agency contribution actually changes from one year to the next. So the employee was paying very little towards the cost of the retirement. In 2012, Congress changed the law for
Mhm.
new hires.
Yeah.
And it started with, if you were hired in 2013, first hired civilian service on or after January 1, 2013, or rehired on or after January 1, 2013 with less than 5 years of prior service, you came in paying 3.1%. And they
Mhm.
called these employees revised annuity employees. And there's an acronym for everything. They called them RAVES.
Mhm.
Next year, Congress came in again. And they adjusted it once again to say if you were hired on or after January 1, 2014, you pay 4.4% into the retirement system.
Mhm.
And they call these people further revised annuity employees. So they call them FRAs. So now when I describe your retirement contribution rate, I have to describe 3 categories.
Yeah.
Hired before 2013, you paid 0.8%. Hired in 2013, 3.1%. Hired on or after January 1, 2014, 4.4%. But still, the government is still paying the bulk of the cost
Mhm.
of the retirement now pension.
Yes, yes. So we have a question that came in
Mhm,
about supplements, about the
mhm.
first supplement. And the question is, does your supplement start immediately, or do you have to wait until all the figures are finalized?
No, you do have to wait. In fact, before I answer that, let me give a little bit of background. For some of you might be saying, what is this supplement?
Mhm.
So when they designed the FERS system, they said FERS is 3 parts. FERS basic benefit, Social Security, thrift savings plan. And as I mentioned earlier, you really need all 3 parts of this for a decent retirement. Well, then they said, you can retire at when it first opened in 1987, you can retire at 55, just like CSRS employees can, with 30 years of service. Now they moved this out this has been changing over the last 30 years. Now the minimum retirement age is 56, 57 for some of you with 30 years of service. Well, how can you have a full retirement at 57 if you can't get Social Security until you turn 62? Hit a little snag there. So when they designed the FERS system, they took the Social Security Amendment of 1983 that said all new federal employees have to pay Social Security. They wrapped this federal retirement benefit around it and then said you can retire at 57. Doesn't work. So OPM pays a supplement to make up for the Social Security part until you turn 62.
Okay,
But
okay.
when you first retire, OPM, it takes 4, 5, maybe even 6 months for OPM to process your retirement file. But in the interim, they put you in a special payment status, an interim payment status. Usually about 2 months after you retire, you should receive these. It's a rough, quick, low estimate of your annuity. So now in answer to the participant's question, when they calculate your interim payment, it does not include the retiree supplement. It's
Mm.
only about 80% of your FERS basic benefit. When they finalize your retirement 4, 5, 6 months later, then you would get a retroactive adjustment to make up the difference. Now, I like to warn FERS employees, this is pretty serious. Your paychecks are going to stop, right? You're going to get a lump sum annual leave check, and that's what most people use to kind of tide them over this processing time. Then you get this FERS basic benefit, which is about 80% of your FERS benefit. You're not getting the retiree supplement yet.
Mhm.
So you need to really look at your finances and say, can you handle all of your expenses? For maybe, it's really more like 4 to 5 months. I always like to give 6 as the outside.
Yeah, yeah.
Can you
Yeah.
handle your expenses? If not, look around and tell me where you've got cash available that you can take care of your expenses. I don't sugarcoat anything in a lecture. It's, this is the way it works. And I'm sorry, this is the way it works, but this is the way it works. So you have to really pay attention. Most people, it's the lump sum annual leave. So I always say, save some annual leave there at the end. If I were going to retire at the end of June, I would be doing my vacation in July, not in May. I'd wait until after I retired to take my vacation and stockpile some annual leave in there.
So the first supplement is paid after the annuity is finalized.
Yes,
And so is that retroactive?
it is. It's paid retroactive. So eventually you'll get this payment. But the problem is during that processing time, do you have enough cash on hand? Do you have funds to take care of your mortgage and take care of all of your living expenses? If not, you need to kind of think about that before you retire.
Okay, all right. So it sounds like everything will be retroactive. The annuity will be retroactive and the first supplement will be retroactive as well. It's just that you're not getting any of that first supplement during that interim time.
Exactly.
Okay. So another question from one of our participants says, if you were hired before 2013, did they adjust the payment to the new rates?
No, if you were first hired in a career appointment, civilian appointment, before 2013, you're paying 0.8%. So it's less than 1% of your salary that you pay into the FERS retirement system. So the change in rate was just for new hires.
All right. So let's talk a little bit about those people that have survivors, right? Because we know that a survivor under the federal government is a spouse. So what are their entitlements as far as retirement? What entitlements are they?
So let me back up before we even get to retirement. Let me touch on what are the survivor benefits that are intact on the death of an employee. If you died as an employee, what happens to my spouse? So if you have 18 months of service, there's a basic employee death benefit paid to a spouse. It's a lump sum, and it's $40,000, $40,279, I think it is. It's an odd number because it changes with cost of living, plus half of the final salary. It's paid as a lump sum to the spouse. Children, unmarried, under age 18, under age 22 if still in school, or it could be an adult disabled child who's incapable of self-support because of an injury or a disability that started before age 18, entitled to benefits on the death of a parent, employee, or a retiree. And that rate is $636 a month. However, the child benefit is offset by any Social Security child benefit that's paid to any child in the family. Well, most of my employees, my federal employees, their Social Security child benefit's higher than 636. So it really wipes that out until the youngest child turns age 18, because the Social Security benefits end at 18. So this benefit could be paid through college years. If the employee had 10 years of service, dies as an employee, then the spouse would get that basic employee death benefit, which is $40,000 plus half of the final salary. And they'd also get a survivor annuity, a recurring payment. And that would be 50% of whatever that person's retirement would have been if we calculated it on the day that they died. So if they had 24 years of service, the retirement would have been 24% of the high 3 average salary. Spouse would get half of that. So it's all automatic on the death of an employee. When you get in your retirement, though, that's when you have to choose your survivor benefit. And you can choose a full benefit, cost you 10% of your retirement. In the event of your death, it pays out 50%. You could choose a partial benefit, cost you 5% of your retirement. In the event of your death, it pays out 25%. But if you're married, if you don't elect the maximum, you do have to have your spouse's notarized consent. Or you could choose, if you had a former spouse, you could split it up between a current spouse and a former spouse, but you'd have to have your current spouse's consent. And you can take no survivor benefit with consent. You can't evade consent. So what I tell people is, what I like to do is, let's take a piece of paper and write Bob and Betty. And we're going to list all Bob's income. We're going to list all Betty's income. We're going to look at their assets. We're going to look at their expenses. And then we're going to cross Bob out. What do we need to do to supplement Betty's income? Do we need to provide a survivor benefit? Or can we do this with some other funds? But again, as I mentioned before, if Betty's not a federal employee, if Bob doesn't elect a survivor benefit, she's going to lose her health insurance when he dies. And we don't want Betty, a senior, with no health insurance.
Right, definitely. So I have a question from our participants. Rosa wants to know, how is sick leave calculated for retirement?
Okay, so sick leave is included. It's not included for eligibility. When I say you need 30 years of service, you do need 30 years of service. But the sick leave is added onto the service to calculate the dollar amount of your retirement. So if you had 30 years of service and 6 months of sick leave, you're going to get 30.5% of your high three average salary. Now, what they do with the sick leave, though, is when we calculate your time, your service time, it's calendar time. When we think about sick leave, we think about work days. 40 hours is a week. So we have to take the 40 hours and kind of stretch them over the week to make 40 hours into 7 days as we add this together. So when we get really close to retirement, I want to take all your service, years, months, days, all your sick leave, years, months, and days, add it all together. And then we drop off the odd days from the total, not from the sick leave. But that's one of the kind of fine tuning things we do that last couple months before you retire.
Right, exactly. So I wanted to kind of go back a little bit on those benefits, because we know that a lot of times when an employee first starts working, they fill out those beneficiary forms and then they forget about them. And then they have those life events that come up. And I'm sure you have dealt with or talked to employees or their family members where they said, oh, my spouse, my parent said that they updated the beneficiary forms. How important is it to make sure these beneficiary forms are updated?
It's very important. And we've all got horror stories about all the life insurance that went to the former spouse, Betty, right? We all know those stories, that whenever there's a life event, you really have to change your beneficiaries. And on that note, I think most people probably know this already, but the Thrift Board revamped their website last year. And about 25% of the beneficiary designations did not migrate over to the new website. So everybody needs to go into the TSP website. You have to log in, and you might have to create new credentials to log in. Make sure they've got your beneficiary forms on file.
Yes.
Everybody should do that.
Yes.
Now, the federal
Mhm.
order of precedence, if you didn't fill out a designation, now if there's a designation, that takes precedence over everything. But if you've never filled out a designation, there's 4 designations that we could have in our federal file. There's one for the money in the retirement fund, that little 0.8% that comes out of your salary. There's one for unpaid employee compensation. That's your last paycheck and your annual life. There's one for your life insurance, and then there's one for your thrift account. And the way it's paid out is, for all 4 of these, is the beneficiary designation. That takes precedence. So if you divorced Betty, but you didn't change the designation, that money's going to Betty, right? If there's no designation on file, if you never completed it, it would go to your spouse. If there wasn't a spouse, it goes to children, adult children. If none, parents. If none, estate. If none, next of kin, according to state law. But if you're not following natural order of precedence, you really need to keep an eye on your beneficiary forms. And it might be nice for your survivors to have a folder somewhere that gives all this important information. I have a speaker that works with me. She's real cute. And her homework, she does estate planning. And she says, for your homework, you have to go to Michael's and buy a binder, like a 2-inch binder. She said, get a colorful one and then get some markers. She likes the ones that have sparkles in them. I like sparkly markers. And she said, on the side of this, you're going to say, when I die, that's the spine of the binder. And she said, in there, I want your beneficiary designations. Let them know what you've got. Don't make them fight for it. And I thought this was really interesting. We're kind of getting off topic, but I thought this was really interesting. She said, your bank accounts. She said, it used to be if mom died, you collected her mail for a month and you knew who all her bills were. You knew everything if you collect the mail for a month. Now mom dies, there's no mail. Everything's automated. And she said, mom could have a bank account at ABC Bank with $100,000 in it. I don't even know about it. So list your bank accounts, give your survivors some information. I thought that was a really interesting point.
That is true.
Don't have mail anymore.
That is true. That is true. Everything now is just basically automated to where you're opted into the paperless option unless you opt out. So not just having the bank accounts information, but maybe passwords to certain accounts so they can log in. It could be to your email when you have all the information or something like that. So that was a great suggestion that person gave.
And then another one that she suggested and is if you have long-term care insurance, tell somebody before you die. She said she's had clients that after they die, they find out that they had long-term care insurance and they say, we just paid $200,000 for mom's care in a nursing home. We didn't know she had a long-term policy because she had dementia. She didn't remember. Tell somebody about your long-term care insurance so that whoever is going to take over. In fact, what's interesting, a little tidbit on this, I do have long-term care insurance and with the federal plan, and they sent notices recently to say, if I didn't pay my bill, who should they send the bill to? Meaning if I was suffering dementia, don't cancel my policy because I'm not paying the bill. Tell my son that I didn't pay the bill.
Wow. When you thought about that, that's something that you didn't even think about. Like, who should pay your bills if you don't have, if something happens to you, not physically, but mentally or physically when you're incapacitated, not
exactly.
Away.
So I thought it was nice that the long-term care partners solicited this. They sent it to me to say, we've got you down, we've got your husband down. You want us to tell anybody else? It's like, oh yeah, if I'm not paying my bills, tell my son.
Yeah. So that brings up two things for me, but the first one I wanted to go back to is the beneficiaries. Sometimes people say, well, I have a will or I have a trust in place. What does that mean, or how does that affect a person's beneficiary?
Yeah, OPM will not look at that will unless there's no spouse, there's no kids, there's no parent, and there's no beneficiary form, there's no spouse, there's no children, there's no parent. Then we'll look at what the will says. It's fifth order. So it doesn't matter what the will says. If you've got a spouse, it's going to your spouse. Or if you've got adult children, it's going to your children. So it doesn't, will does. Now, you could fill out a designation that says to my estate. And now it goes according to your will. But I'm going to kind of give a disclaimer here. I'm not the attorney. And so that's the kind of thing you really want to talk about with your attorney.
Okay, great. And then you mentioned about long-term care. And I know that OPM put a pause, I'm saying it's a pause, on long-term care. Do you know the status of it as of now?
No, when they first paused it, it was for 2 years. I haven't seen anything. Was that, when did that start? It hasn't been 2 years.
It hasn't, I don't think it's been a full 2 years, but it's been almost.
I think it was December of 2021, but I know it hasn't come back. It hasn't come back yet.
But it sounds like those who are already in or covered under the federal long-term care, your policies are still in effect with no problem.
Correct.
Okay, good.
So we'll keep an eye on that coming back.
Okay. And I just want to make sure that our participants know, please continue to type into the chat your questions, like and share this information so others can join and learn about their federal benefits and retirement and entitlements. Because being in the DC area, everybody knows some family member that has worked for the federal government. And if they've been in DC, like as long as I have a native, then you might have worked for summer youth employment and have credits that you could have towards your federal retirement. So tell us a little bit about that, Joanne, because some people don't realize that back in the 70s, in the 80s, that they worked as, back then they had STEP and SCEP, the student employment programs,
Right.
or if you worked in the summer youth employment programs, then, or as a temporary employee.
Okay,
that-
so for an active federal employee, so
Mhm.
there's all different types of, there were entry level positions that were these
Right.
temporary type positions. And a temporary position, if it was less than a year, was not subject to the retirement system. This is
Mhm.
under the FERS system. I'm not going to go into the old CSRS system. Well, if it was performed before 1989, you can pay a deposit and get credit for that service. It's a very small deposit. It's 1.3% of what, so let's say I started in a temporary type position in 1986, a not to exceed 1 year appointment. And then I converted to career and started paying into the FERS retirement system. I can get credit for that year of service in 1986. I have to pay a deposit. It's 1.3% of what I earned in 1986. So you're not earning very much. So it's a very small deposit, and you do have to pay interest, but that would give me another year of credit towards my retirement. Now, unfortunately, if the service was after 1988, it's not creditable. And every webinar I conduct, I have to break that news to someone that even though their service comp date that they see on their standard form 50 includes that service, it's not creditable for retirement.
Yeah.
So post 1988, non-deduction service, temporary type service is not creditable for retirement. Now, on your standard form 50, that's your personnel action. It shows you a service computation date, and that's for leave purposes. That's to decide when you hit your 6-hour leave category, when you hit your 8-hour leave category. If you go to your employee benefits statement that comes out every year, you can go to that and it will show you on page 1, and it's either through your Employee Express or your EPP. You can find, if your HR office could help you find this. That gives you 2 service comp dates. One is for leave purposes. The other one's for retirement purposes. In most cases, they are identical. The difference would be is if you had this temporary type service where you didn't pay into the retirement system.
Right. So thanks for sharing that information. How about those who had active duty military service?
Oh, that's huge. So military service counts towards your retirement. And first off, let me say, so active, honorable military service counts, includes service in the academies, includes any active duty in the reserves. And here's one that a lot of people don't realize. It includes those 2-week annual training duties in the reserves. Now, single days and weekends in the reserves don't count, but any of those 2-week annual training duties that you performed while you were a federal employee, like before you came to work in the government, they're creditable, probably not in your file, which means you have to document the service and you have to pay the deposit, the military deposit, tiny deposits, but it's more doing the paperwork. And back when I was doing live seminars, almost every seminar, I'd have somebody who paid their deposit on their 3 years active and didn't realize that we could pay the deposit on these other little, they had 2 or 3 2-week annual training duties before they went in the federal government that are creditable. So 1, you have to document it, 2, you have to pay the deposit. The other one people don't realize are some ROTC is creditable. Summer camps, summer cruises, Navy, Marines, summer camps, when you live and breathe military, not the school year. This is the 4 weeks, 6 weeks, 8 weeks, summer camp. They are creditable. And some National Guard service is creditable. Initial training in the National Guard is creditable. It's federal service. Anytime you're called into federal service by the president, it's creditable. If you were called overseas, it was federal. Much of the other stateside National Guard service is state service, is not creditable. And a lot of people don't understand that if you're in receipt of a career military retirement or a non-combat disability, then you can't get credit for your military service in your FERS retirement unless you give up the military retirement, which is a calculation we'd have to go through. But if you're in receipt of a military retirement for service in the reserves, it's called a Chapter 67 Title 10 retirement. It's the one that becomes payable at age 60. Or if it were a combat incurred disability, you get to keep your military retirement, but you also get credit for your military service in your FERS retirement. Now, there's one more step though. For you to get credit for your military service, you have to pay a deposit into the retirement system. And the deposit is 3% of the military base pay earnings, not your combat pay, not your housing allowance, basic pay, plus interest. But I have never seen a case that it wasn't worth paying this off. We're talking about paying 3% of what you earned in the military.
Right.
And you're getting credit 1% per year of your 2023 civilian average salary. Many people recover this within a year or 2 years of retirement. They make up what they paid for the military deposit.
Right, because it's good. It's giving you extra time that you weren't getting credit for towards retirement, which will increase your money. It doesn't increase the years. It's already credible, like you said, for your eligibility, but it increased how much money that you.
And this is one that a lot of people don't realize. Military happened outside of your civilian career. We can give you credit for it, but you kind of have to bring all this to the table. You got to get the documentation. You've got to get the base pay earnings. You bring that to HR, they'll calculate the deposit. They'll add the interest on. You can pay it off in payroll deduction. You know, I meet people and, you know, within a year, you know, you only notice it the first check. And then a year later, you've got it all paid off and you've just bought yourself 2 more years of service in your calculation.
Right. So basically, a federal employee that is interested in paying their deposit would just have to contact their HR office and find out the type of documentation that they would need and what the procedures are in order to pay that military deposit.
Exactly. And if you have a piece of paper and a pencil, I can just tell you, one, you're going to need your DD 214, right? Your discharge. If you have the 2-week annual training duties, you need to send off and get documentation of that. You use a standard form 180, which is in the National Archives website. Once you get your documentation of military service, then you're going to go to OPM's website. And you go to retirement, there's a little drop-down menu, forms and publications, RI 20-97. So it's a retirement information form 20-97. It's a request for estimated base pay earnings. You send that off to the appropriate military pay center with your documentation of military service. They'll give you an estimate of your base pay earnings. Now you have everything you need for HR. I mean, HR can walk you through this, but if you want to get one step ahead of them, get the base pay earnings together and the documentation, then you go to HR and they'll just calculate the number for you. And you can write them a check or you can set up payroll deduction. Best thing you ever bought in your whole life, totally employee responsibility.
Yes, yes. And I know that some people were probably trying to capture all of that. I want to let them know that you can go back and listen to this either through Facebook, or you can go to my YouTube channel. It's going to be there by tomorrow evening. And it is Royalty Business Group. You'll be able to go to the YouTube channel and listen to this as well as past episodes that I've had. So make sure that you do that. I want to get into one other thing. We got about, according to my clock, about 11 minutes left. Phase retirement. You know, you talk to federal employees that they kind of want to retire, but they're not sure of what they're people who are tied to their job. People consider their job like part of them. So what is phase retirement? Tell our audience, our attendees, what phase retirement is.
So before I get into phased retirement, I always have to back it up a little bit and say, let me tell you basic retirement law first. So basic retirement law on reemployed annuitants that's been in effect since like 1982 says that if you retire and then you go back to work in the federal government, you keep your retirement and your salary is reduced by the amount of your retirement. It's offset by the amount of your retirement. So if your retirement was $30,000 and you come back and you got a job for $100,000, you're going to keep your $30,000 retirement that OPM's paying you, and you're going to make $70,000 in salary. If you work a whole year, you can earn a supplemental annuity. So you keep your old retirement, now you earned another little retirement on top of it. If you work 5 years, you can either take the supplemental annuity or a redetermined annuity, where we throw everything back in and we recalculate based on the new average salary. Well, that salary offset took some of the fun out of that. So the first thing that happened was the National Defense Authorizations Act of 2010, which changed the retirement law to say that an agency could reemploy an annuitant for up to 3,120 hours. And if you're working half-time, that would be 3 years. But there were these hourly limits, and you had to meet certain criteria for this. And with this, you kept your retirement and you didn't earn, and you just got your hourly salary. So it was the ability to go back to your agency and earn your hourly wage, but with no firm commitment to how long you would work. You didn't earn any extra retirement. Well, then the bigger thing that happened was phased retirement, which actually went into law in 2014. And phased retirement, you actually retire and you get part-time retirement. You go back to work working part-time and you get part-time salary. Now I'm going to rattle off some of the details to this. While you're in phased retirement, you have your part-time salary, your part-time annuity is paid by OPM. Even though you're working part-time, you have full-time health insurance, the government, full-time government contribution to your health insurance. If you died, you're treated like an employee. You'd have the basic employee death benefit, and your life insurance would be based on full-time salary. And while you're in phased retirement, they don't reduce your annuity for survivor benefit because they're going to treat you like an employee if you die. When you retire again, so I use an example that this person works another 2 years, and then they retire again. They fully retire. So now there's two parts to their retirement. They get 50% of the old retirement, and then we calculate the new retirement, and they get 50% of the new retirement. And that's the composite retirement. And what I've always seen, what I've always thought was the appeal of this is, I really like my job, but I'm tired. I think I'd like my job even more 20 hours a week than 40 hours a week. I think the psychological transition to retirement is the key. Now, the key requirement for this, 50% of your job in phased retirement is spent mentoring. So I always tell people, think about your job, go back to work, look around, tell me what in your day could be listed on your job description as mentoring. I think most people nearing retirement are mentoring. Fortunately, OPM left the definition of mentoring to the individual agency. Mentoring at IRS is different than mentoring at Fish and Wildlife Service.
Yeah.
So they left it to the individual agency. You can go to OPM's website and just search phased retirement, and it'll take you to a homepage that describes more of this. You can apply for this. It's not an employee entitlement. The agency has the discretion to approve all, some, or none of the phased retirements. You can apply, but it doesn't mean that you'll necessarily get it. But I think it's a way of phasing into retirement.
Okay. And so what are the limitations on phased retirement? How long can a person be in phased retirement?
Well, it's up to the agency. Now, I know I work a lot with Commerce, and I understand that Commerce is using a 2-year time frame on their appointments. Now, they could offer you another appointment, but that's what I understand. So it's up to the agency. The time frames is up to the agency also.
And so with the end of whatever the time frame is, the employee would either have to take another appointment, either come back as a full employee or fully retire.
Exactly. And once you're in phased retirement, you're not committed to the 2 years. If you said, I'm going to do this for 2 years, and then 6 months later you said, I think I'm ready to go, you can leave anytime you want. I mean, you're still eligible to retire. You're fully retired.
Right. So one thing also that I know that, or some retirees or employees think about, is when they are ready to retire, they feel, I need to give my notice. When do I have to give my notice to retire? What do you recommend?
So on a paperwork standpoint, most agencies, most HR offices would like 3 months lead time.
Mhm.
Give them a heads up that you're thinking about retiring. And I say, ask your agency when they would like to see your paperwork. Now, I'm going to leave it up to you and your boss when you're going to tell your boss,
Mhm.
right? Now, technically, you could go in tomorrow and retire tomorrow, as long as you're eligible. Once you've met the age and service requirements, you could retire tomorrow. But you need to decide when you're going to tell your boss, and you might be training a replacement. And then most HR offices want 3 months lead time because they need to get a lot of paperwork together. And you want to make sure that they do it carefully and slowly, and so that it's all ready the day you actually leave. Then your HR office will separate you. Well, they'll send your case to payroll. Payroll actually separates you from service. Now, I work with one small agency, and they told me they don't need more than 30 days. Well, they've only got 1,000 employees. It's not like, they've got a smaller number of employees. They can handle that. But most agencies like 3 months lead time. But I say, ask your HR office when they would like to see your application.
Yeah, and especially with those, well, now, since COVID, every month is a busy month, but you had in the past, and probably still now, where employees wait until the end of the year. Is that a benefit for employees to retire at the end of the year?
So the story with that is the lump sum annual leave.
Mhm.
As you know, we go through use or lose. We go through leave cutoff every year. And while we're employed, we've always got our eye on the leave cutoff date, right? Because you don't want to lose any of your annual leave. You're going to make sure you use it up before you use or lose date. So if you retire before that use or lose date, you are paid for all of your leave. So this year being 2023, and you have to look at each year, I believe the 26th pay period actually ends. Let me look at this now.
Actually, I think there's 27 pay
There's
periods.
27, but 27 goes past the first, goes into 2024.
Right.
So let me back up. For FERS employees,
Mhm.
your annuity always starts on the first of the month. So if you retired on December 31st, your annuity would start January 1.
Mhm.
So let's look at going out December 31st. You've completed 26 pay periods. Now, if you waited and went to January 13th, and you retire January 13th, even though we have 27 pay periods, your annuity doesn't start until February 1.
Mhm.
So you've got a pay gap in there. So most people don't want a pay gap. So we look at going out December 31st. And if you came into this year with 240 hours and you saved every hour of leave all year long, you didn't take an hour off, no annual leave all year. By the end of the year, by December 31st, you could have 448 hours of leave
Mhm.
saved up. And if you retired, it would be paid to you because you didn't go through leave cutoff yet. And it would be paid to you in 2024, not on top of 12 months of salary, but in a presumably lower income year, and a year that you get to control your income a bit because you decide how much money you're taking out of your 401k plan. So
Right.
that's why people go out at the end of the year. Now, I always like to caution with this one also, though.
Mhm.
That's why people go out at the end of the year. To me, the best time to retire is the day you wake up happy retired.
Mhm.
And for me, it's not December. I don't like the dark months.
Mhm.
I don't like November. It's getting darker already. I know it. It's
Yeah,
getting
it
darker
is.
already.
It sure is.
I don't like November. I don't like December. I don't like January. I don't like February. I don't like March. April's okay. I really like May because I garden. I could entertain myself all day long, all by myself, happy as a lark.
Yeah.
I retired December 31st, and I will make somebody miserable in January because I'll have too much time on my hands, and I'm never going to have 448 hours of annual leave. It's just not going to happen.
Right.
So the whole story about the annual leave, about retiring at the end of the year, is stockpiling the annual leave, retiring before the leave cutoff date, big lump sum annual leave check, and a lower tax year, which has some financial advantages to it.
Okay. All right. So, and someone's just put in, Miss Rosa said, me too, May is a great month. It is a great month. It is a great month. And so one more thing before I cut off for today is that we realized that you mentioned that if for first employees that they retire, OPM wants to retire at the end of a month and the annuity starts at the beginning of the following month. That doesn't mean they're going to get the money on that next month. You have to be retired for the full month and then you get the annuity the
Good
following
point.
month.
Yeah, you're paid on the first of the month for the preceding month.
Yes.
Right. Yeah,
yes,
that's a good point.
Yes, just like when we work, we have to work
And then you're paid.
and you get paid 2 weeks later or whatever your pay cycle is. You have to be retired and then you get paid your retirement annuity at the following month. So you get paid like a month behind.
Right, exactly.
Yeah.
Yeah, good point.
So
Lots of little details. As you see, there's a lot of little details every step of the way here.
There are, and every retirement is unique. So what your retirement is be different than my retirement. And like you mentioned before, what we do after retirement is different for each person. So you have to keep that in mind. Like, what is it that you want to do after your retirement? It's not just about the money. This, like you said, the first thing you mentioned when we started was being, how much people say, how much money am I going to get? But you're changing your whole mindset and your lifestyle. And so you need to like, what's my purpose after retirement?
Yeah. Well, I've talked to people about retirement for so long, and I've always said, first off, I think for most people, like this is my little amateur analysis, for about 75% of people, once you start thinking seriously about retirement, I think it takes about 2 years to wrap your mind around it.
Mm-hmm.
And for most people that I work with, federal employees, by the time we add up all your benefits, it's not the money. The money's okay.
Mm-hmm.
It's the psychological part when you're really ready to do this. I like to say it's when it's not fun anymore. So I used to work with an agency, and I'd worked with them for years and years. A couple of years ago, it was pre-COVID. This girl caught me in the hallway near the cafeteria, hollered from the hallway. She said, Joanne, it's not fun anymore. And she was under CSRS and she had a great retirement. She said, I'm going out December 31st because it's not fun anymore. And she could fully retire. And, it took her a couple of years to get to that point that I'm ready to go. So I think for some people, it's when you say, you know what, this really isn't that much fun anymore. And it was fun before. And you're just getting tired. And if you look at the numbers and you add everything up, you might be surprised. It's not the money holding you back.
Mm-hmm.
There's more to a job than a paycheck.
Exactly. Joanne, thank you so much for giving out this
Thank you. It's been fun.
information. I do appreciate you. I appreciate everybody that has joined us this evening and every month, my faithful followers that have been with me every month. I just thank you all so much. So next month, I'm going to have Paul Barrows. He has his own business and he's going to be talking about how you can automate your business to things that you need to send out, like those text messages, those email blasts, all of that, how you can automate it, put it in one system so it can just go out scheduling, because I'm just learning how to do that. I used to do one email at a time and one text at a time. So Paul Barrows with My Automation Suite, he's going to talk about that next month on September the 13th. 7:30 Eastern time. Thank you so much, everybody, for joining. Thank you again, Joanne. I appreciate you and everything that you do.
Have a nice evening, everyone.
Thank
Bye.
you.
Bye, Sharon. Thanks.
Bye-bye.